We are in conversation with Ajit Dayal of Quantum Mutual Fund, but today the topic of discussion is not outright markets, but a very important factor into the market in the long term for investors to understand is the importance of corporate governance whenever they are analyzing companies, making investment bets. But not only that, even for corporates, it is a very important factor to observe the best corporate governance practices in order to attract the best quality money over the long term. But Ajit, great to have you on the show. I want to understand what a timing. I mean, there's a exuberant bull market out there. Some are calling it's a aging bull market. Some are saying in the middle of a bull market. But bull market usually is a time when issues like corporate governance don't find much, listeners. So how come you timed the note and the research note with along with your team around this time?
Well, I'll start with a few things, but again, great to see you and great to talk to all your viewers. So basically, I think if you look at the economy, I'm going to talk a bit about the macro. It's all flashing green. To us, it looks very good. Elections are out of the way. I think there's a consumption cycle that's going to start, an investment cycle that's going to start. So all that is good for the economy. Stock markets were flashing a bit of red right there. We think valuations are very stretched, and we think people should be extremely cautious about what they're doing with their allocation to equity now. We have to be very, very careful about that in our opinion. And it's in times like this, as you correctly pointed out, when investors have to worry about the quality of the company that they're buying into. And talking about quality, and that's where you have governance coming in, we started the integrity screen in 1996. And in 2019, we launched the Quantum Best Practices ESG Fund, which has now got a 5-year track record as of July 12. So it has none of the companies which have suspect corporate governance, and the fund has outperformed the index on the 5-year basis that has been out there and done very well. And with that, we came up with a little Bible, which is, we're calling it the little white book of governance. And the idea is that, when you're buying something, you have to make sure that you're buying something which, as Warren Buffett says, when the tide turns out, the people with no clothes will stand naked. So companies with no governance will be hit very badly in a market downturn. And it is only because they have good governance, companies will have less of a share price decline. So right now, everything has a stock name to it, has an AI name to it, a tech name to it, is moving up rapidly. And that's a bit of a danger when people get so much caught up in this environment. So I think it's a good reminder from our perspective, but it also is a good time because our 5-year track record of the best-in-class strategy fund, the ESG fund, is out there registered. And it's something that we've been doing as Quantum for a long, long time, right? Even our long-term value fund that we launched in 2006 with the 18-year track record, even that has this valuation and integrity screen built into it to sift out companies with poor corporate governance, very importantly.
Sure. Ajit, let's break it down, one from the company's perspective, because a lot of companies are out there right now in the process of raising funds, supplies very active. And then we'll go from the investor's perspective. From the company's perspective, suppose there's a promoter A who likes to take some money out of the balance sheet every year, say amount B. Over the long term, say a 3-year, 4-year period, you have 4 times that B amount. But isn't that a great idea to leave that in the balance sheet, grow it over next 5-7 years and actually get valuations many times over on your balance sheet very nicely, protecting all that profits in it, residual?
So yes and no. I think the objective is what does the founder want to do. So many founders, take the example of Bill Gates, right? He's been reducing his shares in Microsoft for decades. He's announced a plan. Every month they're going to sell so many shares, no matter what the price is. And they extract the money. Now when you do that, there's a lot of visibility to the market in terms of supply. The market is aware how much stock of Microsoft is going to come from Gates and from other founders, and they take that into the supply-demand equation. And from Gates' perspective, he's made wealth, he's got a foundation, he wants to help the world, and he's using that in a very sustainable way to take that money out of one stock and through his Gates Foundation and family office buy a basket of stocks and assets around the world and de-risk, because keep in mind that the foundation has a liability, right? If you're trying to create vaccine for AIDS, for malaria, or whatever it is, there's a certain cost that you're committed to. And you need to have certainty of cash flow from the foundation's perspective. Now, if you're in only one stock, Microsoft, and the share price goes up and down and there's no dividend or high dividend, the foundation cannot have a year when they don't get money. So from a perspective of a philanthropist founder, it makes a lot of sense to announce this plan that you're going to, like the case of Premji in India, did the same thing. He's announced how much money he's giving away to the foundation, and then the foundation takes that money, invests in a whole basket of assets, including public stocks, real estate, private equity, venture capital, the works. And they may get a lower rate of return than a Wipro stock. That's possible. But it's a more established certain rate of return, 7, 8, 9, 10% in dollars, which will pay for the foundation's liabilities as it's doing its work, for its salaries, vaccinations, everything else. So that's on a foundation level. But even from a private perspective, if I want to buy a bigger apartment, I want to buy a house, yeah, I should be allowed to sell my shares. It's not a sin. I remember that Rakesh Jhunjhunwala had said years ago that his worst investment was buying the property in Bombay when he sold stocks. But you can't have only stocks. You have to have some enjoyment in life. So there's nothing wrong with the founder exiting. The question really comes in governance. Is a founder exiting because he or she knows something bad is about to happen, some inside information, if you will? Or is it because they really believe, like I said, in this philanthropic purpose, or using it for their own needs over time? That's the balance that you have to look at as to why the founder is exiting. And any sale should not necessarily be seen as a signal of weakness in the company, right? And I think that's the important distinction to know.
And more so, I was actually referring to promoters who milk the balance sheet out, not practicing the best corporate governance practice. But I also want to talk to you about how important it is in long-term value creation journey of an investor to be very careful and cognizant of names they are getting into and not be careless about getting into weak corporate governance kind of names, however juicy or the short-term movement they might actually give. Talk to us about that, because the young investors sometimes get careless about, even if somebody raises a question on corporate governance, they say it's okay, it's just a short-term bet I'm taking. But over the long term, why is it important to give perspective on that?
So in the long run, if you're a shareholder in the company, even if you've got 100 shares and the founder's got millions and lakhs of shares, you've taken the same risk by being a shareholder. Let's take the case of Ranbaxy. When Bhai Mohan Singh IPO'd the company, and we held shares in Ranbaxy a long time ago in the fund, when they sold to Daiichi, there were two prices paid. There was a price paid to the Ranbaxy family, and there was a price paid to Ranbaxy shareholders. And there was a 30-35% difference in price. And the answer that we were given when we asked that on terms of corporate governance, why should a share which has got the same rights trade at two different prices, one for the founding family and one for us as minority mutual fund shareholders in the Quantum Long-Term Value Equity Fund? And the answer was, well, we're going to do a non-compete, we're not going to compete with them. I said, then have a separate agreement. Don't do it through the share price. Pay them a fee, that's separate. But the share can't have different prices. Now, that was not a case of milking the balance sheet per se, but it's a case of a founder not sharing the wealth proportionately with all investors. And that's something which is, in our view, not acceptable. So we've not been shareholders in any stock of that same founder for years. And that's what we do. We kind of blacklist companies when they do something wrong. We've rarely gone to court. We've gone to court once in our life in the case of ICICI, what they did with iSecurities. But we've rarely gone to court, but we just had a discussion with the management. Either they listen to us and they agree with what we're saying, or they listen to us but they don't listen and continue doing what they're saying. And I think investors have to realize that when money is taken out, it really takes away from their pocket.
If you like this video, then like, share and subscribe to ET Now.